So that was some insightful and informative sessions on direct tax amendments. Now it's time to bring us our next thread in, which is indirect taxation. For this, I would like to welcome Ms. Charanya, Lakshmikumaran, partner Lakshmikumaran, and Sridharan. Charanya has nearly a decade of experience in tax and several years of experience in competition law, insolvency and bankruptcy law, IPR, and electricity laws. She currently handles tax as well as non-litigation at the High Court and Supreme Court, as well as other tribunals and regulatory forums. Good evening, ma'am.
Thank you.
Ma'am, I would request you to take the session forward by sharing your PPT. Just in case you face any issue, please let me know.
Sure, thank you. Yeah, is my screen visible?
Yes, ma'am.
To slideshow mode.
Right.
Right. Great. Thank you so much, Nidima and everyone at Taxmann for having me. As you have introduced me in very kind words, I will be speaking today about the indirect tax amendments, both for goods and services tax, as well as customs. I know we've had some big ticket amendments when it comes to customs this year, whereas I think goods and services tax has been more of housekeeping issues that the Act has been facing, and more in terms of implementation of various provisions of the Act. So without further ado, we'll begin. So I'm going to start with the GST portion. I feel it's easier to handle it. That's why I'm starting with the easy bit. Whereas, customs, I would like to take a little longer. Now, largely, there are 4 different buckets in which the amendments that this year have happened in GST can be categorized into. First is the amendments pertaining to input tax credit, right? There have been issues that the industry has been facing. There have been issues in terms of implementation. Second is in terms of relaxation in time limits. So time limits for, filing certain documents. It was earlier in the September return. Now they've extended it to November. So what is the implication of that? Then, of course, the return filing. We all know that in GST, the filing of returns, the portal, the cross-linking, the two-way matching, all of which has plagued assessees for the past 4 years. I think some of those things they have tried to correct it. Some they have given some legislative backing. And finally, I'll discuss a few miscellaneous amendments. So let's start with the input tax credit. Now, Section 16 of the CGST Act deals with the provision, it's the substantive provision, which gives the right to take input tax credit on the tax that has been suffered on the inputs or input services that have been received for rendering output supply. Now, what is interesting is that they have introduced a new condition under Section 16(2)(ba). The condition being that the ITC is not restricted under Section 38. I will come to Section 38. The new Section 38 has been introduced. It's been completely recast. And the new section provides that an auto-generated statement, which is your GSTR2B, which is a static GSTR2B, which used to be there earlier, will now be made available to the recipient. So the recast 38 allows for a auto-generated GSTR2B. In that, it will contain the ITC which is eligible and ineligible ITC. That statement will be there in GSTR2B. And so there has been now a connection between the ITC that is so-called ineligible in the GSTR2B statement to be read into the eligibility clause under Section 16 itself. So it is a little bit interesting to see how this is going to play out. Now, the statement, of course, as I said, the 2B will contain details of inward supplies where ITC is not going to be available. Now, this section 38 and this therefore is going to, there have been cases where the department has denied credit based on the to be statement. And, they do a 2B, 3B matching. And in that matching, when there is a mismatch, they are denying the credit in those situations. So now GSTR 2B has a legislative backing, because earlier this was only done by way of rules. There was no section which provided for 2B. So now they've brought in an enabling provision for section for GSTR 2Bs, which is 38. Now, what is it really going to contain? This statement, it specify the details of supplies where ITC cannot be availed, either wholly or partly, by the recipient. Now, if such supplies are received from the following persons. So it says that if you receive supplies from the following persons, then your ITC from that particular person, either wholly or partly, is likely to be considered ineligible, and the statement will indicate that. Now, I will read out the 5-6 classes of persons that they have indicated in this, and then there are some interesting fallouts that come from here. Now, the situation is A, a registered person who has furnished details of supplies under form GSTR 1 within such period of taking registration as may be prescribed, right? So there is a person who was perhaps unregistered and thereafter has taken registration. Now, whether he has furnished his GSTR 1 within the specified period post registration or not, such a person and his supply comes under scrutiny to decide whether you will be eligible to your ITC or not. Then a registered person who has defaulted in the payment of GST and the default continues for a prescribed period. This is the second class of person who he has defaulted in payment of GST. Default is continuing. You are ineligible to take the ITC. This is all, as I said, these are all statements which will get reflected in the GSTR 2B, which will make it ineligible for the recipient to take credit. Now, you cannot take credit, so it will show, the statement will show a registered person whose GST payable as per his form GSTR 1 exceeds GST paid by him as per 3B during the prescribed period, and such excess is beyond the prescribed limit. So this is an interesting situation. They say that if there is a person who has declared in his GSTR 1, now GSTR 1, we all know, is the return where he is going to indicate his outward supply, and basis his indication of outward supply, there is a calculation, some total of the tax that is liable to be paid. But tax payment actually happens as per GSTR 3B. If there is a mismatch in GSTR 1 versus GSTR 3B, that is, he's declaring, say, a tax of 1,000 rupees in the GSTR 1 as per his totaling of the outward supply. But in GSTR 3B, he actually only pays, say, 800 rupees as tax. And if it is beyond the prescribed limit, then as a recipient of such a person, you cannot avail credit. Okay. Now, fourth, a registered person who has availed ITC as per form 3B in excess of ITC that can be availed by him as per form 2B, and such excess is beyond the prescribed limit. So yes, so if 2B allows him to take credit of 50 rupees, but in his 3B, he has taken, say, credit of 60 rupees. Then also, this will now get reflected in the 2B that will be provided to you. So it'll come in his 2B, which will be provided to you, which will now show that this kind of credit is ineligible to you. Now, a registered person who has defaulted in discharging his GST liability by utilizing excess ITC than the permissible limit under section 49(12) of CGST Act. Now, there is some amount of clarity that is still required with respect to this section. Now, as I said, Section 16 of the CGST Act is the section that is the enabling provision, allowing us to take credit of ITC. There are certain conditions linked with availing the ITC. As I said, Section 38 has also now been read into Section 16(2)(ba). So whatever happens in your GSTR 2B as per Section 38 is now a condition for availing the credit. So till here we are okay. But what happens in a situation where a person has genuinely bona fidely paid tax? Okay. The problem with the wording of Section 38 today is it allows the 2B to disentitle you from credit based on class of person and not the supply. That is, the way it is worded, it says ITC, so if the supplies are received from a registered person who has done this, or from a registered person who has declared higher amount in GSTR 1 and lower amount in GSTR 3B. So while GST is a supply, is a transaction-based tax, when you are going to block credit, not based on a transaction, but based on the class of person, there is going to be confusion, and we want to wait and watch and see what is going to happen in this, because will the entire credit chain of this particular supplier get blocked? The section itself says wholly or partly, but how much is this wholly or how much is this partly that is going to get blocked? This is a cause of worry. We have to wait and watch how this GSTR 2B is going to look like. Now, Section 41 of the CGST Act, non-payment of tax by the supplier. Now, Section 41, provisional claim of ITC, it has been substituted. ITC can now be availed on the basis of self-assessment itself. Now, there is a small catch over here. In case a supplier has not paid the tax to the government, then as a recipient, I am supposed to reverse that amount of credit. But I am also supposed to reverse that credit along with interest. So take a situation, I am the recipient, I have done my self-assessment and I have availed for a particular transaction 10 rupees worth of ITC, because this is how much I have made payment towards GST to my supplier. It later, it appears or transpires that the supplier has not paid that 10 rupees to the government. Then I am supposed to, as a recipient, for no fault of mine, supposed to not only reverse that credit, but also pay interest on that portion, that credit that I have retained. Now, of course, there is a saving grace that if the supplier thereafter pays the tax portion, then I can re-avail the credit. Now, here there are some lacunae. First of all, how are we going to find out whether he has paid or not paid the tax? There is no communication qua the recipient and supplier when to indicate to the supplier, to the recipient, that the supplier has not paid the tax. So what is the methodology that is going to be followed to indicate that the supplier has not paid the tax? So when is it that I am supposed to reverse? Then if I'm a bona fide buyer, can I now plead ignorance that I do not know that he has reversed, he has not paid the tax? So I cannot reverse until and unless I know it. Can these arguments be taken? Next is, not only am I being asked to reverse the tax, the credit, I'm also being asked to pay interest on that amount. Now, isn't that onerous? Given especially a situation, take a situation where I have excess credit, the amount that I have reversed, I've never utilized that credit in my payment of output tax. So my credit ledger has always been having that delta X amount. Will I still be required to pay interest on it, especially in light of the fact that where credit has not been utilized, really interest cannot be charged, right? So that is also a cause of question. So maybe one can challenge this. Then if I do pay interest on it, I reverse it, I pay interest, and thereafter the supplier pays the tax and I can re-avail the credit, what happens to the interest portion? Is that something one has to forego? Can I make a refund claim for the interest amount? So these are all some very, very fundamental questions when it comes to this operation. And this is something that unfortunately, I don't think the current amendments have really done anything to, to solve these problems. Now, as I said, certain time limits have been revised for various compliances. Now, under section 16(4), which is a time limit for availing ITC, earlier it used to be due date of furnishing of GSTR 3B for the month of September following the financial year, the next financial year. That date has been revised to 30th November. Similarly, under section 34, subsection 2, the time limit to declare credit note. Again, earlier it used to be returned for the month of September, which was in October, which has now been revised to 30th November. Now, the time limit to rectify errors or omissions in GSTR 1. Again, under 37(3), it used to be for the return of the month of September, that has now gone to 30th of November. Extension of time limit for various compliances with respect to, so time limit to rectify any omission, etc. in GSTR 3B. Similarly, it has gone to 30th November. 52(6), which is in GSTR 8. Again, time limit from the return of September, it has gone to 30th of November. Now, what is interesting is that effectively, there has been an enhancement of 1 month. Earlier, because the return of the month of for the month of September used to get filed in the month of October. Now, that time limit has been revised to 30th of November, effectively giving 1 month for all of this. Now, when it comes to returns, there are some amendments. There has been an amendment in section 37(4). Now, this is interesting. It says that GSTR 1, you will not be allowed to furnish for a particular tax period if GSTR 1 for the previous tax period has not been furnished, right? So, this is an interesting amendment that has been made because they want to ensure compliance every month on month compliance. So if there is even 1 month that you miss not filing your GSTR 1, you will again not be allowed to file it for the subsequent period. And similarly, under section 39(10), the same provision has been made for GSTR 3B. If you have not furnished for a particular tax period, then for the subsequent period, you will not be allowed to. So if you have not furnished GSTR 1 for a particular tax period, you are not allowed to furnish a 3B also for the same tax period. So this is therefore linking the 1 and the 3B. Certain omissions have been made, section 42, 43, 43A. Now, 42 used to be for matching, reversal, and reclaim of input tax credit. 43 was for matching, reversal, and reclaim of reduction in output tax liability. 43A was a procedure for furnishing return and availing input tax credit. 43A was not even enforced till date. And these were all sections dealing with two-way communication in return filing, really in force. So it's a good thing that, that's what I said, some housekeeping has been done. Now, few other amendments, not pertaining to returns, etc. One is an interesting amendment in section 29, subsection 2, which deals with cancellation of registration. Now, cancellation of registration by proper officer. They now have two classes of persons. One is composition dealers, those who opt to pay under the composition scheme. And then there's a remaining people in the other class of people. So the proper officer today, after this, once it becomes an act, will be allowed to cancel registration if the composition dealer does not furnish returns for a financial year beyond 3 months from the due date of furnishing the said return. That is, usually composition dealers are supposed to file their returns by 30th April of the following financial year. The April following the completion of the financial year. Earlier, the section used to say non-furnishing returns for 3 consecutive tax periods. Now, really, consecutive tax periods or consecutive months, since they don't file monthly returns and they file a single return. So the section was inelegantly drafted. So here what they have effectively done is they have given 3 months post-April to such composition dealers to file their returns. Once that is done, if that is not done, the proper officer can cancel their registration. With respect to other classes of persons, they have said that non-furnishing of returns for such continuous tax period as may be prescribed. Earlier, it was for a continuous period of 6 months. Now they have said such continuous tax period as may be prescribed. So we have to see they are likely to perhaps bifurcate these other classes of registered persons into further categories and then prescribe certain tax periods. So if you don't furnish return for certain different tax periods, perhaps they will be giving the power to cancel the registration. Right. Now, payment of tax, interest, penalty, and other amounts. Now, this is again an interesting amendment. What has happened is that we have seen in the past that you have a cash ledger and a credit ledger. If there are instances where cash ledger of a particular entity was overflowing for a particular GSTN number, but the entity needed cash for the same entity in a different registration as under section 25, when they become distinct persons, if a different registration of the same person required cash, there was no way to transfer from one cash ledger of the same person to another. Earlier, it was allowed only within the same GSTN number, and that too only between the CGST and the IGST of the same person for the same GSTN number. But now the provision has been expanded a little bit, and they are allowing the transfer of the amount from CGST and IGST, that cross cash ledger amount can be transferred between registrations of the same person, but distinct registrations. So it is no longer within the same GSTIN number, but it is within for the same person who becomes a distinct person under section 25. But certain conditions have been prescribed if you want to go ahead with such transfer. First is that there should be no unpaid liability in the electronic liability register. They've inserted a subsection 12 where they've said that the maximum proportion of output tax liability which may be discharged through the electronic credit ledger should be by a class of persons or registered person will be as may be prescribed, right? So this is an interesting amendment to section 49. What they have done is that they are now trying to ensure that there will be some portion of liability which will be paid through cash. So they are putting a cap on the amount of tax liability that can be paid using the credit ledger. And this was earlier, already there in terms of Rule 86B, but it didn't have a legislative pattern. So that is what they have been achieving with this. Now, section 50, this is an interesting amendment that has been made. Now, it says that interest to be paid by a taxpayer on ineligible ITC availed and utilized. and not just ineligible ITC availed as it used to be. Therefore, it is, so what the section tries to say now is that interest on ineligible ITC, which has been availed and utilized, only in that case, an interest liability will arise. Earlier, it used to be ineligible ITC availed, but dispute was there in situations where it was availed but not utilized, etc. Now, this amendment has been made effective from 1st of July 2017. Well, this is interesting because there has also been an amendment in notification number 13 of 2017 to prescribe 18% as the rate of interest for the purposes of this section. What will be interesting to see is this. Now, we have seen that this is an issue that has been cropping up in the past. Investigation has taken place. Audit queries have been raised on this issue in the past for several assessees. In some cases, people may have deposited this interest at 24% on this ineligible ITC, etc. But now, with retrospective force, they have said that the rate of interest is only 18%. So now it remains to see that this 18 to 24 interest gap, is there some way that one can try to avail refund of this amount? Now, Section 54 of the CGST Act so refund of balance in cash ledger, there is an amendment in Section 54(2) which says that refund of balance in cash ledger through such form and manner as may be prescribed and not in GSTR 3B. Now, earlier, what would happen is that, and there's an interesting amendment in Section 54(10), subsection 10. What used to happen is earlier, if there are refunds that an assessee is eligible, but there are also certain liabilities and demands that the department is seeking to make or is making against such a noticee or an assessee, they could earlier withhold such refunds, but only one class of refunds could be, and that was the refund that was coming due to inverted duty structure or zero rated exports or zero rated supplies. Now that has been opened up. The officers can now withhold any form of refund that the assessee is eligible for, and not just the refund arising out of inverted duty structure or arising out of zero rated supplies. Okay. Then finally, in the explanation, the definition of relevant date for claiming refund under Section 54 to cover specific cases of supplies made to SEZ will be, the relevant date shall be the date for furnishing 3B for such supplies. The problem used to arise because it was inelegantly drafted, where it gave it didn't cover, so to speak, supplies to SEZ because notion was always export. But this has now been corrected a little bit now. Now we'll move to the proposed changes.
Ma'am,
yes.
Before you go to custom, there are few queries on GST. Would you like to take it now or after the session?
I can take it now, no problem.
Okay, so one of our viewers have asked, Sekar, how GSTR 2B can differentiate eligibility and ineligibility as it is unique to each company.
Yeah, understood. So you are right, there is a problem, okay? And this is what I was trying to address earlier also. The problem is that, number one, GSTR 2B is technically supposed to give me a statement of ineligible ITC qua the supplies only made to me.
Right.
But when the way Section 38 is now drafted, it looks like the class of person or the supplier itself, his entire GSTR, his entire ITC is effectively tainted ITC. So how much of that we are going to get, how much of that we are not going to get, there is some amount of ambiguity with it. So we will really have to wait and watch. And also, I'll go back to the question. Oh, I'm sorry, I think, yes. So whether it can differentiate eligibility and ineligibility, Again, so yes, so the problem is, now take for example a situation where, as I said, say assessee was supposed to pay 1,000 rupees as his GST. My supplier has to pay, say, 1,000 rupees as his liability. He has paid only 800, right? Now, how do I know, sitting as a recipient, whether the balance 200 is qua supply made to me or to someone else? I will never know that, right? So when I don't know whether that balance 200 where he has not paid the tax, if it is pertaining to my supply or a supply to someone else, should it be proportionately reduced to all his recipients, or should few recipients face the brunt of this, or will all recipients face the brunt? That is the inelegance in drafting, and that is going to lead to some amount of arbitrariness, and we'll have to see. That's why this is still the issue is not over. They have not been able to solve the problem.
I think gradually it will come.
We have to wait. I mean, it's taken them 4 years, and 2B itself was just floating around without legislative backing. Now at least there is some backing to it. But let us see. As you're rightly saying, we'll have to do a wait and watch policy right now.
Right. Another one is from Prateek. He says, these provisions are so hard to digest. If any mistake happens in filing the return, then what?
Yes, you are right. And we are seeing that issue occurring very, very often, because at the end of the day, to err is human. And we are human beings, and we are all not machines. A lot of it is manually fed, right? So your GSTR1 is a manual fed document. Many a times when it comes to B2B, B2C, we have seen situations where people have by mistake put a B2C in a B2B or a B2B in a B2C in my GSTR1. Okay. Then what happens is there is a mismatch. There is going to be a mismatch in my 3B because of that. There is going to be, obviously, you're going to see these mismatches. So now my 1 and 3B are not going to match. If that matching is not going to happen, there is going to be a problem with my recipient being ineligible to take credit because of not matching. So there is a lot of, it is very difficult. And it is difficult also, as you rightly said, we are all humans. Correction of these returns, I think we keep going back to court, but unfortunately we have to keep in mind that the timelines that are there, that are given. Now we've got a recent judgment in the case of Bharti also, where they've said that a timeline for a return, statutory timeline, even courts cannot extend. So that is something we have to be very mindful of. Maybe try and see as much as possible, try to have a real-time correction, at least at your end, right? The other thing which, before going to customs, now that we are on that point, the other thing that we must have in mind is, do your vendor due diligence properly. That has really come to the fore right now. We are seeing very big established companies where maybe because of lack of vendor due diligence, few people have not paid their output tax liability properly, because of which even established bona fide buyers are facing issues. So that is actually a big issue that we are seeing. Secondly, with respect to non-payment of tax by, say, a vendor, you have to start drafting your contracts properly. Make sure you have a proper valid contract, have an umbrella contract with your vendors, so that if there is for example, having to pay interest, right? If tomorrow I cannot recover interest from the government, I should, in my contract with my vendor, provision for that, so that I can recover interest which for the tax he refused to pay or he failed to pay on time. So therefore, how you contract, how you do business, everything has to, we have to raise the bar at how we do business in India at the end of the day.
Absolutely. Absolutely. I think that's all. You may take it ahead now.
Yes, thank you so much. Yeah. Right. Of course, the elephant in the room, which is the major amendment that done in the in customs this year, which is amendment dealing with proper officer. Now, the case of Canon India, which was argued by Mr. Lakshmikumaran last year, was a landmark judgment because the Supreme Court had said in that judgment that it had said two things actually. First, it said that the notifications under Section 2, which is a definition clause of the customs, designating a few officers to be proper officers was insufficient because the powers of officers was actually flowing from Section 6 of the Customs Act and not from Section 2. So one finding of the judgment was that the notifications have not been issued under the correct section. So because it's not issued under Section 6, we can't consider them to be proper officers. But the judgment also said another thing, which is that the officer or the proper officer who assesses the goods should be the proper officer who issues the show cause. So the principle of comity, which is the person who assesses the bill of entry, there should be a doubt in his mind that at a later point in time, when new information and new data is brought to his knowledge, it should be a doubt in his mind whether he has assessed it correctly. And the very same proper officer can thereafter issue show cause notice within 1 year or within 5 years, depending on suppression, fraud, etc., etc. Now, what has happened is that, okay, and also as a result of Canon, now the case of Mangli Impex is still pending in the Supreme Court, which deals with post Syed Ali, all those notifications that had got issued, it deals with that issue. Canon India is post Mangli Impex, and the review against Canon India is still pending in the Supreme Court. Canon India has also been followed by various high courts and again reaffirmed by the Supreme Court in a couple of cases. The impact of this judgment was that all the show cause notices issued by DRI, customs preventive, customs audit, etc., went into a tizzy. We did not know what to do with it. There were circulars issued and instructions issued to place these show cause notices in call book. Now, what have they done this year, to deal with this damage, that was brought upon by this judgment? The definition of proper officer under Section 234 has been now amended to include officers covered under Section 5. And then Section 3 of Customs Act has been substituted. They have increased the class of customs officers has been increased to include officers of DRI, customs preventive, and customs audit, right? Then a new subsection was introduced in Section 5 of Customs Act for providing for powers of officers of customs. Subsection 1A provides powers to the board for assignment of functions to officers of customs, then notified officers to become proper officers in relation to assigned functions. Then there is a subsection 1B that has been included, which provides senior customs officials like Principal Commissioner, Commissioner of Customs, gives them the power of assignment of functions to other customs officers subordinate to them in their respective jurisdiction. So therefore, effectively, subordinate officers can also become proper officers. So effectively, what has happened in this amendment of Section 2, Section 3, Section 5 is that DRI officers, customs preventive, as well as customs audit officers have been declared to now be proper officers. Now, subsection 4, it widely outlines the criteria of the board, what all they can consider while assigning functions under subsection 1 and 1A of Section 5. So now they can look at territorial jurisdictions, persons or class of persons, goods or class of goods, cases, it could be a random computer-generated assignment or any other criteria. So to give some sort of a backing or a theme or a reasonable classification to assign functions. Why is it that they will assign, there's some rationale for assigning functions of proper officers. So they said you can use these as the guiding lines for assigning these functions. Right. Now, subsection 5 provides that the board by notification may vest concurrent powers in 2 or more customs officers for functions to be performed under the Customs Act. So now what can happen is multiple officers can perform similar functions, such as in the faceless assessment scheme. So you have the concept of one officer performing a particular function and exhausting his role. Sort of, they are trying to dilute that and say that multiple people can be granted the same function. Now, there is a clause 96 of the Finance Bill, which is a very interestingly worded clause. It seeks to retrospectively validate, it's a validation clause, it seeks to retrospectively validate certain actions taken under the Customs Act. Now, what does it really validate? It validates all the notifications that were issued earlier under Section 2, under Section 3, 5, etc. All those notifications were relating to assignment of functions and appointment of officers, etc. It has validated them and also deems them to have been issued under Section 6 of the Customs Act. So effectively trying to deal with that portion of the judgment, saying that you've not issued these under Section 6. And it also says, the validation clause also says, the newly amended Section 2, 3, and 5 are deemed to have effect for all purposes as if in force at all material times. So effectively giving a retrospective shade to the amendments that have been carried out this year under Section 2, 3, and 5. Now, there's another interesting Section 110AA that has been introduced by virtue of this year's amendments. Now, Section 110AA is part of a chapter which deals with search and seizure. Now, this section, what it provides is any customs officer other than the proper officer cannot issue a show cause notice demanding duty. So that principle that only a proper officer can issue a show cause notice to demand duty, that has been maintained. So what happens when a search, audit, seizure, arrest, etc. Is being done by an officer of customs who's not a proper officer, but he believes that recovery of duty, interest, drawback, refund, etc. There has to be a show cause that must be issued, but he can't issue the show cause. So it's a section which says that such an officer, if he believes that an action has to be taken for recovery of duty, interest, drawback, refund, etc., then the officer having jurisdiction as assigned under Section 5 of the Customs Act shall have the sole authority to exercise jurisdiction for further action like reassessment, adjudication, etc., consequent to the completion of such inquiry, investigation, or audit. Right? So therefore, this officer cannot issue the show cause, but he has to provide a report, investigation report, to the proper officer who has been assigned that particular role or power under Section 5, and that person, the other officer to whom he then refers the matter, only he can issue the show cause. Okay? So he has to effectively transfer the case along with an investigation report to the proper officer. Okay? Now, in case there is a multiple jurisdiction, there are imports that have happened across different ports in India, then a report can be forwarded to the proper officer, which the board assigns. Sometimes you have a common adjudication officer. So if such a case is a proper officer defined by a board, then he forwards that to that particular officer. Now already we know that a similar provision exists in SVB matters also. So now bringing this in line with findings in Mangli Impex as well as Canon, this is a positive step. Now, there has also been an amendment to Section 14 of the Customs Act. Section 14 deals with valuation, an import and the transaction value has to be determined. Now, the proposition or the concept when it comes to either classification or valuation is that, especially in valuation, the concept is that the officers have to accept the transaction value. The only reason for rejecting the transaction value are limited reasons that are contained in the custom valuation rules, contained here and then read with custom valuation rules. The onus always lies with the department to prove that there has been undervaluation. Either they show the existence of some agreement where additional payments have been made, or they show this is a transaction, the sham transaction, or ABC, different reasons, or that related party transaction, therefore it is a suppressed price, etc. Now, as per this amendment, they have proposed inserting a clause 4 after clause 3, which enables the board to cast additional obligation on the importers in respect of certain class of imported goods, where the board has reason to believe that value is not being declared correctly, considering the trend of declared values of such goods or other relevant criteria. So, in many cases, we have seen customs officers doubting the value of the goods imported based on NIDB database, based on contemporaneous other importers declaring the value to be different than what this particular importer has declared. But they are not able to find other reasons of, say, undervaluation in terms of agreement, related party, ABC. They are not able to find it. And that has also led to several cases, several show causes that have been issued to be quashed or to be set aside. Now, by doing this, and they will prescribe a class of goods because they cannot do this for all types of goods. There are certain classes of goods typically subject to this, iron ores, etc. Now, in such cases, there will be a class of goods that will be notified. And for those goods, the obligation will now, the burden of proof will now be shifted to the importer to prove that he is correctly valuing his goods, right? Now, we'll have to wait and watch what kind of amendments they will bring to the custom valuation rules and what kind of additional evidence they expect the importers to place on record. Now, advance ruling, there is a very interesting twist, one can say, to the advance ruling. Now, we know that in terms of in Customs Act, under Customs Act, the advance ruling mechanism has been working quite well. We have it's a very positive step. It gives importers and the exporters outside India, it gives them a very good idea about some sort of certainty as to how the imports are going to be classified, how the imports are going to be valued, how at what rate they are going to be paying these taxes for a particular period of time, for actually all times to come, because the advance ruling is binding on both the SSC as well as the department. Now, this year, what they have done is they have put a shelf life to these advanced rulings, and they said that these rulings will be valid only for 3 years, or if there is a change in law or facts. Okay. Now, so therefore, advanced rulings going forward will have a shelf life of only 3 years. Now, what is to happen after those 3 years? We will have to wait and watch. Can we ask for re-examination? Will this have enough persuasive value, etc.? So these are certain things that one has to analyze. Now, all the advanced rulings that have already been issued, it says that once the finance bill receives the assent, they will be valid for another 3 years from the date on which the assent is granted. Some questions, that come in our mind is what happens to future imports post the 3-year period, and if the customs changes its mind and decides to revise the classification, decides to revise the valuation, then can they invoke extended period? Because ideally, all of this information is already placed before the authorities. So these are some interesting connotations that one can see arising with respect to advanced rulings. Now, certain procedural rationalization has happened with respect to advanced rulings. I'm not going to go too much into it, except for the last point, which is that currently, from the date of filing an application for advanced ruling, within 30 days, an applicant is allowed to withdraw. Now that has been changed and amended, and it's giving the assessee or the applicant a flexibility to withdraw anytime before an advanced ruling is pronounced. So now the window for withdrawal has increased. So this should encourage people to apply more frequently to the advanced ruling, and you can hedge and see what kind of views the department is taking, and then decide whether to continue with the advanced ruling or withdraw the advanced ruling application. There have been some amendments made to the import of goods, the IGCR rules, which allows bonded manufacturing actually. Now they have made these rules now geared towards a more automated, digital, and transparent mechanism. People will be now granted a IIN number, which is an identification number for a person who's entered into a bonded manufacturing. He has to give details of the product he's going to manufacture, his inputs, etc., the rate of duty, all of those things he has to provide in the platform. It's a one-time, you have to give these details as a one-time measure. You'll be issued an IIN. You have to keep a bond, keep a continuous bond alive. And the IIN and the bond number will now have to be declared when you file the bill of entry. The bond will get debited when you file a bill of entry. Now, an interesting clarification, so to speak, that has happened by way of the present amendment is that it puts a time limit of 6 months for utilization of the imported goods. Earlier, there was the 6-month period was not there for actually utilizing the goods. Now it says you either utilize the goods or you re-export it or you sell it on payment of duty for home consumption. But now there is a 6-month window that is now fixed for this bonded manufacturing. There is a clarification on social welfare surcharge. I'm not going to go into it for lack of time. The SEZ Act is now going to be rehauled. All of us are waiting, very excited to see what they're going to bring about. The SEZ Act has given an impetus to the commerce and industry, but there is a view in the industry and perhaps now even shared in the government that perhaps it has outlived its utility. Certain tax exemptions and the 10-year tax-free periods coming to an end. What meaning are we now going to give to SEZs? How can you extend these benefits? So I think it'll be interesting to see how they're going to overhaul the SEZ system. And last, just before I conclude, I want to only talk about one thing. This time, there have been many changes in the customs tariff. They have done a huge rationalization exercise when it comes to the rates in the customs tariff itself. A lot of entries are going to see sunset clauses in the jumbo notification, as we call it. And they will be phased out, and they will be, and a lot of them from May 22 onwards are going to be found in the main customs tariff itself. But what is interesting is the impetus given to something called phased manufacturing program. I know there is a project import thing also, but the phased manufacturing program is a little more interesting. It's something that we are trying to do in a very novel way. The government has, there are 3 products that they are going to give an impetus to, which is wrist wearable devices, hearable devices, and smart meters. And typically so as an example, I've just given an example, typically how it will work is they have identified all the different inputs and the different products that are going into manufacturing this final product. And for various inputs over the next 4 years, they are slowly increasing the import duty so as to encourage domestic production of each of these inputs within India. And it'll be interesting to see how the phase manufacturing program works out. There are some interesting amendments pertaining to electric vehicle also. There is a push towards import of electric vehicles in completely knocked down sets, assembled or sub-assembled. And hopefully there is a push for public mobility of electric vehicles and import of such vehicles. Hopefully we'll see a very, very good positive response to these programs. Thank you very much for having me here today. I know I have many more slides, but I'm going to stop now. Thank you.
Thanks a lot, ma'am. I think this was one detailed analysis everyone was looking forward to. Thanks a lot for your time.